All right. Good morning, dear friends, and welcome to our third webinar that is called Market Run. As usual, I'm gonna give you some updates on recent important market developments and give you our views that we have currently on different asset classes. Just for the ones that are new to our webinar and that maybe don't know our company, Katch Investment Group is an asset manager, an asset management boutique, and we are currently managing several funds in the private debt space. But apart from our asset management activities, we also provide services, CIO outsourcing services to banks, multifamily offices, and broker dealers. So I think it's very interesting right now to talk about markets. It was a bit boring over the last couple of months, so finally we have some action in the markets again, and important, obviously, right now to know our views and how we position ourselves given the recent market volatility. So really, the markets have been doing pretty well until the end of July, and as we discussed last month, the markets were basically up because in June, July, there has been made some progress in terms of trade conversations between the US and China with the meeting in Japan, and markets also started to anticipate a looser monetary policy. So we basically saw that the market started anticipating rate cuts by the Fed over the last month. The markets, equity markets cheered this. So the S&P 500 was up around 21% until recently. The Nasdaq was up, if I'm not mistaken, around 26, 27% until recently. And really things were going pretty well. But in basically, we knew that this sort of environment cannot last forever because monetary stimulus was already priced in, and on the other hand, we knew there's going to be probably also some friction in terms of trade talks. So what happened basically last week is that we had the Federal Reserve meeting, the FOMC meeting, and as expected, the Fed cut interest rate by 25 basis points. This was really no surprise. The market was down a little bit that day on Wednesday, but just because there was some economists were expecting a 50 basis point cut, and the Fed just cut by 25 basis points. But this wasn't really a surprise. I mean, we all knew that the Fed is going to cut by 25 basis points, and also the explanation by the Fed chair Jay Powell was completely reasonable, because basically he said that it's a mid-cycle adjustment. Still, we don't really have an economic crisis. The economy is still relatively strong. At the same time, there's not a lot of inflation. There are obviously some economic indicators that are pointing towards a slowdown. It's basically what we discussed also last month with some, especially the manufacturing segment of the economy is slowing down. So it sort of made sense to cut by 25 basis points right now. And also they basically said it's not really the start of a new rate cutting cycle, but probably just an adjustment. But in the future, they're still gonna assess the economy, obviously at their meeting. But the message was not extremely dovish during the meeting. That's also why the market was maybe down a little bit. What happened thereafter was basically what we saw last week is, first we had the comment of President Trump, and we have been discussing this for quite some time, that with this president, it looks like it's very tough to have an independent monetary policy. There has been a lot of verbal intervention, not really intervention, but verbal intervention and criticism about the monetary policy. So I'm going to read the tweet of Donald Trump just following the meeting, and he basically said, as usual, Powell let us down, but at least he's ending quantitative tightening, which shouldn't have started in the first place. No inflation. we are winning anyway, but I'm certainly not getting much help from the Federal Reserve. So it's really you can basically read between the line that you can see a lot of almost war rhetoric that we are winning, referring also to the trade wars that he has initiated against many economies. And he basically means that in order to win the war, it's not really about winning the war, but that's the rhetoric that President Trump is using. He also needs more support from the Federal Reserve. And he has basically been asking for more rate cuts for quite some time, and he has often stated that he's completely disappointed by the monetary policy by the Federal Reserve. So far, so good. I mean, this wasn't a big thing, but then basically, as his usual way, one day after, President Trump basically announced new tariffs, 10% tariffs on the remaining 300 billion US dollar goods from China that are exported into the US. I mean, this 10% tariffs is just a threat that would be implemented in September, so it's not affecting it. But it's obviously a clear escalation in terms of the trade truce or the trade talks that we have been seeing, because it's really going back to April, one can say, when the trade war also escalated towards towards the end of April. So this was really a big surprise to the market, and the markets tanked, which is sort of understandable, because one big part of the recent increase in equity markets was really that the progress that has been made in terms of trade war. What happened thereafter is basically that the Chinese, they responded. They didn't really respond, but they have let the yuan to depreciate a bit more. Basically, the yuan crossed the 7 yuan level per US dollar, which means that we have now really the weakest level for quite some time in terms of the yuan. And the US, Trump, the administration, they respond and basically said that China is again manipulating the currency in order to be more competitive on the trade side. So which basically a currency manipulation story that we've been seeing over time. So the view of the market was basically, okay, more tariffs, the Chinese are responding with a currency depreciation. This basically means that we have a sharp escalation in terms of the trade war, and it's really a risk-off environment right now. So equity markets tanked sharply. The S&P 500 was down 6% over the last 3 days. The Nasdaq was down 8%, and emerging market equities were down around 10% over the last 3 days. So it's really a sharp correction in a very short period of time. Actually, yesterday was the worst day in 2019 in terms of equity markets, and also at the same time we had some corrections also in the risky fixed income segments. For example, we had a big the high yield spreads. They moved up quite significantly. So right now, before the escalation, the spreads were at around 370, 380 basis points. And right now the spreads are at 460 basis points. So we had the 80 points spread widening over the last couple of days in terms of height. So it's really a risk-off environment. And at the same time, investors are again buying US treasuries. So we can really see in these charts how the yields have come down quite massively over the last days. You can see it especially in the 2-year yields that are down a lot, and also the 10-year yields that have corrected sharply. So right now, it's really the question is what is going on in the future in terms of rate cuts and whether this can calm the markets. So right now, if we look at the expected movements of the Federal Reserve, we basically see that in September, right now, it's almost 100. The market is anticipating a cut for 100%. So the probability is 100%. So the question is really Is it going to be a 25 basis point cut or a 50 basis point cut? Before basically the escalation over the last couple of days, markets were expecting a 25 basis point cut, most likely. But right now we have more than 30% probability of a 50 basis point cut. It's probably not going to happen. It's extremely unlikely that the Fed is going to cut 50 basis points in September. But it really rises again the likelihood that we will see more rate cuts, because the market is expecting much more and Trump is expecting much more, and the markets are already correcting. So it's going to be very tough for the Fed to not to cut, which basically means that also the Federal Reserve in the US is losing a lot of power. It's also losing a bit of credibility, and we can see that there's really a big fight going on between President Trump and the Federal Reserve, because it's obviously not a coincidence that Trump is announcing new tariffs just one day after the Fed meeting, and after expressing his disappointment with the result of the Fed meeting. So one day after, he's going to issue new trade measures, which basically puts the Fed into the position where they have to react and basically do what the president was asking for in the first place. So it's a very, very, very tough situation right now for the Federal Reserve. And this is probably the playbook that we continue to see for many months. So it's likely that we will see some progress on the trade side again in terms to also to calm down a bit the nerves of the investors. But if the markets recover and the probability of aggressive cuts come down again, it's also possible that we will going to see the same playbook. So we're going to see new measures by President Trump in order to basically to force the Federal Reserve to cut rates. It's very important that the rate cuts are not going to have a big stimulus effect on the economy in the very short term. So usually economists, they talk about a delay of up to 18 months. So it's not going to help the economy much in the short term, which probably also means that if we have more trade fights and threats in terms of new tariffs, it also means that probably in the short term, short to medium term, that the economic indicators remain relatively weak, especially on the manufacturing side. I mean, last month we showed a chart with the different PMIs, purchase manager indices, and we basically showed that all major indices right now are below 50, which means they are in contraction territory. The only one that stays above 50 is the US manufacturing, the ISM manufacturing index, which in July reached a level of 51.2. So it's still slightly above 50. It was disappointing still because analysts and economists, they expected 52. So it was coming at below expectation, but still it's the only indicator that remains above 50. But given the recent news and the decline in equity markets and the announced tariff hikes for December, the new tariffs for September, it's also likely that the indices are going to worsen further over the next couple of months. And eventually we're going to see also the US PMIs, the manufacturing PMIs falling below 50. So means that the news flow, especially for the manufacturing sectors, is going to be rather on the weak side going forward. What does it all mean for risky segments or equity segments and for investors? I mean, as I said before, the drop has been pretty sharp. So 6% was a pretty sharp drop in a very short period of time. It's a bit a similar situation as we had towards the end of April and the beginning of May, but this time the decline was much faster than in May. So in May we had also a drop of around 8% in the S&P 500, but it take much longer to see the correction being realized. This time it just took 3 days for a 6% correction, so it was pretty sharp. Today the markets are slightly up, but probably it's it can be that we're going to see a bit more weakness in the short term, because it really takes some time to re-establish confidence over the next couple of days. So important support levels for the S&P 500 are 2,780 and then maybe 2,720, which could be eventually buying opportunities in equity markets. Right now, the problem is also that we don't expect a lot of news flows. We already know that trade talks are not going to be resumed until September. So in August, we don't have a lot of news flow coming. We are still in earnings season in the US, so we are obviously looking at the earnings. And right now, it looks like the second quarter EPS earnings season has been relatively solid. So we expect that earnings growth is going to stay above 0, so at around 1% for the second quarter of 2019. It's a very, very similar situation as in the first quarter, when expectations were also for a slight earnings recession. So earnings were expected to be down in the first quarter, and were also expected to be down in the second quarter. But right now, it looks like the earnings season has been pretty solid. So right now, we have around 80% of the companies already reported earnings, and the beat ratio was around 75%. And we have a surprise ratio of around 5 to 6% right now. So the results are stronger than expected, especially on the EPS side. The revenue side, the picture is a bit less positive. So we only have 59% of the companies that beat expectation in terms of revenues, which is not very strong also in a historical context. And at the same time, guidance has also been rather on the conservative side. So that's also what we see in this chart right now. So right now, it looks like for Q3, the expectations are even a bit more negative in terms of earnings. And we have seen some downgrades for Q3 EPS growth in the US. So just in July, which was basically ahead of the equity correction, but in July, analysts reduced their forecasts for Q3 EPS by 1.6%, which is normal. Usually ahead of the earnings season, analysts tend to reduce the forecast, and then companies can beat. But now the hurdle is relatively low. So probably if this trend continues, the expectation is going to be much closer to -4, maybe even -5% growth, especially given the recent correction and the uncertainty we're seeing in markets. So if we're going to have expectation of -5% EPS growth for the third quarter, the risk to have a slight earnings recession is obviously much higher. Even if we have a beat by companies, probably it's going to be 0 or slightly negative in terms of earnings growth in the third quarter. So we don't believe that the earnings are giving much support to equity markets right now. And it also means that the main driver for stock markets right now continues to be news related to monetary policy, and also news related to the trade talks. It's probably going to be a volatile August, because we don't expect too much news right now. Maybe just to add something to the Chinese yuan story, I mentioned it briefly. It's really questionable, or probably it's complete nonsense, that the Chinese are really depreciating the currency on purpose right now to be more aggressive on the trade front. Because if we look at the depreciation of the yuan this year, it was only around 2.5%, something like that this year, which is almost nothing compared to most emerging market currencies. And if anything, the Chinese authorities in the last couple of months, they basically stabilized the currency, and maybe they prevented the currency from depreciating further, because what is really depreciating the currency is not China, but it's more the markets, and the markets are really driven by the trade war rhetoric. So if anything is true in terms of yuan depreciation, it's more likely that Donald Trump is the main responsible person of the depreciation that have been seeing in the yuan over the last couple of days. It's important because we saw that when the US administration, basically they accused China of manipulating the currency. They eventually they're gonna talk to the IMF to come up with this story once again, and the likelihood that they're gonna persuade anyone, it's extremely low, because it doesn't really make sense at all. So probably the last hit that we saw in the equity markets in terms of the China depreciation story, that is going to be much more aggressive in the future. It's probably not going to happen. Actually, today we saw that the Chinese, they fixed the yuan again slightly below 7, so which is also alleviating the concerns a little bit in terms of currency war and trade war and so on. And it also led to a slight rebound in terms of equity markets. So this is something that might help to stabilize the market a little bit in the short term. I mean, we might see, as I said, a bit more volatility over the next couple of days, but it's not extremely likely that we're going to see an outright trade war over the next couple of days and further announcement and so on. So probably we're going to move up and down a little bit, a couple of percentage points, but we're probably going to see some interesting entry points in terms of investors wanting to buy a little bit more in equities. So as I said, we probably might be willing to buy some equities if the S&P 500 reaches a level at around 2,750, more or less. So in terms of our asset views, we still believe that the most important thing is to be disciplined in any market. It's very tough, as we said many times, it's very tough to time the markets, because we knew that trade is going to cause a correction sooner or later, but you can never know when exactly this is going to happen. So we have been reducing our exposure to equities ahead of the crisis, so we are slightly underweight equities right now. For those of you that follow also the publications and the articles we write from time to time, we expressed this view in a press article at the beginning of July, when we said that markets went up too fast, and probably when the S&P 500 reached 3,000, we recommended to be slightly underweight in equities. We didn't expect the correction coming that fast, but we knew that the upside is going to be more limited, and that sooner or later there's going to be a correction. So right now we have a correction, and probably it's going to be a good opportunity to reduce the underweight or even move to neutral if we see some further weakness in terms of equity markets. We still like emerging markets, which is a very tough area right now. Emerging markets were just up around 10% until recently, and they lost 10%, so they're basically flat for the year. So no performance, but still, especially China has suffered a lot. China, they also implemented a lot of stimulus quite some time ago. So probably the worst can be avoided, and the valuation is extremely attractive. So it's a bit of a risky play, but if there is some progress in terms of trade going forward, the rebound can be extremely sharp. So we keep our preference for emerging markets. On the fixed income side, it's very tough right now, because as you saw, yields are very low right now, so it's not easy to invest into fixed income securities right now. So we still like emerging markets and some niche areas in terms of fixed income. I mean, we bought some US Treasuries last year when the yields were at 3.2%, and right now I believe that we will need to increase a little bit our holdings for US Treasuries, especially 10-year Treasuries. Maybe if yields are closer to 2%, it's we have been talking about 2.3% as an interesting entry opportunity. I think this call was a bit unfortunate, because we really didn't get there. But right now, everything close to 2%, I think it's an attractive level to get into yields, because as I said before, we now know what the playbook is, because basically Trump is going to use the Fed to get lower rates to be able to be more aggressive on the trade front with China. So it's very likely that we see more rate cuts over the next month. And it's possible that we're going to have much lower yields in a year or two, especially if the trade war continues and we see some further worsening in terms of economic indicators. So I believe that interest rates are really moving down, and sooner or later this is going to be more reflected in terms of 10-year treasury yields. I mean, it looks a bit stupid right now because we could have been buying much more treasury yield at yields at around 3%, but still 2% is still much more attractive than in many other markets, like in Germany, where we have clearly negative yields, or in Switzerland and Japan and so on. So there is still a carry compared to other relatively safe markets, and you know, it gives us some protection, because we don't really know, and if something really goes sour in terms of trade discussions, I think it's a good strategy to build up some more U.S. Treasury holdings, especially as riskier segments of the fixed income markets are not extremely attractive. So right now, high yield could be a tactical buying opportunity, because as I said, the yields have gone up, the spreads are at 4.6, so it can be attractive, but if we buy something, it's rather a tactical play in terms of high yields, because what usually happens is, if you are in the later phase of the economic expansion, and you go towards the end of the economic expansion, then you might have a risk of a recession. Theoretically, credit spreads tend to widen, and this spread widening usually happens before we have a bear market in equities. So it's not a wise strategy to be very aggressive in terms of credits moving towards the end of the economic cycle. So given that we just have a neutral view on equities and a slightly cautious view on many fixed income segments, we still like alternative investments, of course, and it really gives us much more stability in the portfolios. It's also the reason why we manage alternative investments as a firm, especially private debt as an alternative for traditional fixed income assets. We have been showing that also during very tough environments in terms of markets, like last year in November, December, or also this year in May, and it's going to be the same in July and in August this month, that when markets correct sharply, private debt remains a very, very stable market, and returns are very consistent over time. So especially given the limited upside that we see now for equities, and also the limited upside of the low yields that we have in fixed income areas, so it's a very good complement for investors. In terms of equities, we believe that the market is going to be range bound. It's not going to fall off a cliff, maybe going to down a little bit, and then it can recover the losses to reach again 3,000 or even above in the next couple of months in terms of the S&P 500. But then the upside is also pretty capped. So we really see that the market is a bit manipulated right now. So we have a Fed put and a Trump put, because we have elections next year, which basically means that if markets go down and economic indicators get worse, the Fed is going to be more aggressive in terms of cuts. So this should support the market. And if this is not enough, then Trump is going to announce something positive in terms of trade, because he really wants to be tough. But at the same time, if we get into a recession next year, he's going to lose the re-election. That's not his plan. So that's also why we have sort of a Trump put. So if the market goes down much more, probably he's gonna help. And at the same time, if the markets go up, it gives them more room to be more aggressive again. So that's really what's going to cause a range-bound market. So it's always very tough to play the markets like this. So I wouldn't be moving around too much in terms of portfolios, but just moving to neutral when we get closer to the lower bound of this range, and then again to underweight equities if we get above 3,000 again in the S&P 500. So that's going to be more or less the playbook in terms of equity strategy over the next couple of months. So I think with that we talked about everything a little bit. I hope that it gives you some guidance in terms of these turbulent markets. As always, it's very important to stay disciplined and calm. There's no reason to panic. It's never a good advice anyway. So if you have questions, you can send the questions directly to me, or you can type in the questions in this webinar, and then we can look at the questions right now, whatever you prefer. So I'm gonna wait a minute to see whether there are some questions coming in, and at the same time, just want to thank you for your attendance. and hopefully we're gonna see each other again in the next webinar. We're gonna do in latest in 1 month's time.